Hello, everybody. I'm Andrew Beaudry.
And I'm Ryan Cummings.
Welcome to your Bread and Butter podcast.
Today, we're talking about the Federal Reserve, inflation, and tariffs. Who's the Federal Reserve, and what sort of impact do they have on today's world?
Exactly. The what, why, who, and where.
Stay tuned.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer. Member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Private Financial Design LLC are not affiliated.
Bread and butter.
Hello, everybody. I'm Andrew Beaudry.
And I'm Ryan Cummings.
It's your Bread and Butter podcast today. We're talking about the Federal Reserve, inflation, and tariffs.
If you've ever wondered who is the Federal Reserve and what exactly do they do, we're hoping to maybe unravel some of the mysteries that maybe the average person doesn't understand about the Federal Reserve's role in our government here today.
Absolutely. I was with somebody this weekend picking up some flowers from their farm, and their immediate response to me was, love the podcast. Have a question. Could you do a podcast on the Federal Reserve? Because we don't know what it is. We never were taught that in high school.
So here we are.
Here we are. The who, what, why, and where. So let's talk a little bit first about why the Fed was even created and what that's all about.
Yeah, so the Federal Reserve, back in the late 19th and early 20th century, the U.S. was suffering from repeated banking panics in 1873, 1893, 1907. And so banks often failed. Depositors lost money and the credit markets froze. So there was no central institution to help provide liquidity and oversight. And, it's kind of a last resort to lenders, if you will, to add that layer of protection that the Federal Reserve kind of eventually was instilled for.
Yeah, and even back then, currency values were different. A pound over in England had a different value for what it could purchase in England compared to the American dollar. So the money supply here was largely tied mostly back then to gold and national banknotes. And this created sort of a liquidity shortage, and particularly during the farming seasons, because we were 90% or 80% agricultural, including, cotton and corn and things like that we would ship overseas. And it made the economy vulnerable to shock, where if you had a bad harvest for cotton or corn, all of a sudden some of those banknotes weren't as valuable, and there wasn't anything to back it up. So they wanted a system that could expand and protect the currency and the value of the dollar.
And that's a lot of what we see even today that the Federal Reserve does when they want to contract the economy. They think it's growing too quickly, quell inflation. That's one of the more recent dynamics of the Fed. We saw them raise interest rates, try to slow down the economy. And then when we go into recessionary cycles, they do just the opposite. They lower interest rates, stimulate the economy, and try to keep things in balance, at least to the best of their ability.
And when they raise the interest rates, that strengthens the American dollar, and so less of our goods are able to be sold overseas because it costs more for other countries and companies to buy our goods. The other reason why the Fed was created, and this is a very timely topic, the political and economic pressures. Business leaders, farmers, and politicians debated back then and for a good 60 years how to stabilize the monetary system. And progressives were pushing for greater government oversight of the banks, while bankers wanted a system that gave them a more reliable credit system without too much government interference. In other words, they wanted to be able to do banking without the government putting their thumb on them all the time.
We still see a lot of that today.
Oh, yeah.
It's this ebb and flow of more oversight or less oversight. And, it's something where there's a balance that's needed, because as we've seen, when we have times of maybe not enough oversight, we have events like the 08-09 banking crisis. Mm-hmm. There's not quite enough oversight. And, just the opposite. When we have too much oversight, you maybe, could disagree with some of what the Fed does here and there with interest rate moves. Maybe
Absolutely.
They're moving too slow, too quick. So there's a balance that needs to come in between of, too much versus too little oversight.
When how that happened really was the first real big panic was in 1907. A lot of people don't realize that. Most people just go back to the Depression and the post-Roaring 20s. But actually, in 1907, the United States economy completely was on collapse, and it was personal financiers, wealthy people like J.P. Morgan, who personally invested to stabilize the market. It alarmed the public and highlighted the need for there to be some type of oversight that was a little bit more solid. And so Congress took action in 1908 to study reforms. And finally, after years of debate, the Federal Reserve Act was signed into law by Woodrow Wilson in December of 1913. Now, the reason why that's important is that the first real collapse that occurred was back in 1873. So it took 60-something years, almost, it was 40 really, 40 years to get to that point. But it takes another 20 years to get to the Federal Reserve Banking Act, that actually the banking system got, taken care of because of the Depression.
And it takes time with these things. I mean, just like, almost any process, it takes time to evolve and, change over time and get to where we are today, perfect systems. And we've even seen that, even once the Federal Reserve was created, we've seen a lot of those changes. Back in the 30s, there were reforms after the Great Depression to help centralize banking in the mid 30s. So we had some different legislation moves there.
Well, that's because of the Depression. All the banks were just going under.
Right. All right. And so there's need for those things. And as our economy changes and we hit these unprecedented events, speaking of which, things like world wars as well. You have supported, helping support World War II by borrowing at low interest rates, things of that nature. The Fed steps in at many, many times and kind of creates these new strategies and new policies as, that they eventually still even use, some of which today, that we've seen from these big events that happen, over the course of our country's history.
And during the Truman era, as president, the Treasury and the Fed restored complete independence from the federal government so that it would not be influenced by any political influence whatsoever. And in the 1970s to 80s, inflation was rampant. Money market accounts were paying 16%. And people thought that was wonderful, but mortgage rates were also 14, 16, 17, 18%. Not so much fun. But inflation was so bad, Volcker, who was the president of the Fed at that time, they fought inflation with really sharp interest rates and made things really tight and really got a hold on it. And then there was also a national, we'll say, influence or decision by Congress and the presidency to tighten up the federal budget to not be overspending. And then we had 2008, and really that was a major crisis because basically all of our banks were bankrupt, had no money.
Yeah, and the Fed stepped in and bailed out, a lot of the large banks and allowed those banking systems to continue and not fail. And those arguments, some people say they're like, well, should they have just failed? And I think there's arguments the other side too of it could have the chaos that could have ensued afterwards. So there's reasons behind what the Fed does, and even going back to you were just talking about in the 70s and 80s with the rate hikes. I mean, they that's just I think a principal strategy of the Fed that they still use again. Even very recently. Yeah. But, me personally, I'm definitely glad that they didn't do it quite the same way they did in the 80s because, we saw some hikes, but, we're not in the mid-teens and whatnot when it comes to
that was the most record historical interest rate hikes as far as like length of time. It was short and quick. Yeah. And it really did nub it down pretty good. So, we move on to the next item here in our Fed's evolution. So they were created to be an independent agency that would help bring liquidity to the federal dollar. And it has a board of governors. There's 7 members that are appointed by the president. Has to be approved. Can't just be appointed, has to be approved. And then there's 12 regional reserve banks that have operations all across the United States. And this particular group also sets interest rate policy as to what they're doing. And we can see some of that happening today. And part of that, too, is you and I know because we're in the business, but part of what we got to in 2007 and 2008 was the loosening of the banking rules that were put in place in the 1930s, from 1933 to 1938. And when they loosened up the banking rules, banks were able to once again go back to the 1920s and basically invest in whatever they kind of wanted to do with very marginal safety measures. And of course, that's where we got the whole housing crisis and credit swaps and all that kind of garbage. So those, restrictions have been put back on the banks. And I have a lot of banking friends, so I'll try to be gentle here. But when you let people just, run the gamut, whatever they want to do with money, it doesn't work out very well. It usually doesn't work well with your personal budget either if you just go out and spend a bunch of money. So let's talk about some key takeaways here that people can know and understand about the Fed and where it's at today and maybe where they're going.
Yeah, so as you can tell so far, the Fed's, it's evolved. They've done a lot of different things over the years, and where they originally started out as kind of just helping with liquidity management for the country, they've expanded their role to, like you were just alluding to, monetary policy, different financial regulations, and even crisis management, as you were just discussing in the banking crisis of 08-09. And so they've got this broadened role now where they're helping with things like keeping prices stable within the country, making sure that, we're not either, one, expanding at too crazy of a rate where inflation's running out of control and businesses are making more and more money and driving up prices, and they're used to try to keep that in check. But we're also, our economy's not tanking through the floor and able to recover from things like maybe bouts of recessionary like activity or just even overall economic contraction. So they help with that price stability as well as helping with employment standards. Their control over interest rates can either help slow down or help generate jobs. And we've seen a lot of that over the course of this year, even with some of the recent discussion of possibly cutting rates. Jerome Powell has said it multiple times this year up until just recently that part of really the two reasons he's not wanting to cut rates is, inflation is still been a little higher than he would like, even though it's not bad, still a little higher than he wanted. And employment data was still very strong up until just a few months ago. Now, that's kind of changed recently, and we've now seen Powell turn his viewpoint a little bit and discuss more openly the possibility of cutting rates this month in September, and that's their role.
And when you cut those rates, it does allow for more economic expansion, but if it allows too much, then inflation gets out of control and it kills everybody. By the way, though, I don't know if you heard about the man who blamed his nasal congestion on his job loss at the Fed because he lost his job at the Fed. Did you hear about that?
I did not hear about that, no.
Do you know what he did?
I don't know. What did he do?
He sued a Fed. Yeah, he sued a Fed. That's what he did. So anyway, when we're on this capital drawdown or input from the Fed, you have to understand that this is a complex role. It's not just about, let's lower interest rates. They're looking at some very complex numbers. And so let's start talking a little about where are we going and where are we heading to. So let's talk a little bit about inflation.
And we already started to allude to this, but you'll kind of see some of what the Fed's dealing with when they look at these numbers. So we look at just a few months ago, actually coming up on almost a year ago, end of last year, we had the CPIU, which is the Consumer Price Index specifically for urban areas. It was right around 2.9%. That's the measure of inflation, 2.9%.
This is since December of 2004.
Yes, right, end of last year.
Yeah.
So that is from year over year, from basically December 23 to December 2024.
Right.
Now, the Fed has said multiple times, if you've been following the news at all, they want inflation down at 2. I don't know if we're necessarily going to get all the way down there.
Yeah.
We got down to about 2.3, I think, at its lowest. But as at the end of last year, we were in the 2.9 range. We saw food prices at about 2.5%. So groceries about 1.8, dining out about 3.6. So a little bit of a delineation there. Energy actually was creeping down because this is, again, to remind everyone, this was a year of recovery from a high 2023 inflation year. So energy was actually down about 0.5%. Electricity was up, natural gas was up, but overall energy down about 0.5%. And then core goods and services, so these are excluding food and energy. And there's a reason the core number's used is because food and energy is very seasonal, very volatile. So the Fed often uses two different inflation numbers, total inflation and core inflation without food and energy. And that was at about 3.2% because Food and energy can skew the inflation numbers one way or the other. So that was the end of last year. And the Fed still did not love where those numbers were. They were coming down from 2023, but they didn't love where the numbers had ended the year on. So there's still more work to do.
Yeah, and it makes sense. So from December till now, this year, the overall core is 2.7, so a minor little dip down. Groceries are up 2.9% since December of this past year. Energy is still down, with gasoline being the least expensive, but electricity is up 5.5%, and natural gas is up a whopping 13.8%. So core inflation is actually just a tad bit higher at 3.1%. And this is really prior to really tariffs being kicked into gear here at the end of July. So we'll see how things go forward.
And this speaks to the Fed's concerns, right? We don't see, when we talk about the 2024 numbers versus current 2025 numbers, we're seeing a little bit of a reduction, but not a whole lot. And that's with the Fed really not touching interest rates since December of last year. They kept them high. They're hoping to have it continue to contract and cool the economy. And it just really hasn't done it. Yeah, we've gone down a little bit, but again, the Fed wants 2. We've gone down from 2.9 to 2.7. That's not where the Fed wants it.
2%. I mean, those were the glory years of 08 and 09, but we were also coming out of a recession. So I mean, it's slightly cool. There's no doubt about it. But there's underlying pressures. And so, these are 12-month year-over-year changes and not cumulative price changes, too. So you got to be careful. And not all the goods and categories have been broken out. Apparel, used cars, appliances, things like that. And the producer price index as well have shown a sharper increase in some goods like appliances and electronics, hinting at possible future consumer price increases, but it's not been passed on to the consumer yet. But that day is coming. They'll allow some of those profits to be eaten into. They'll lay off staff and they'll stop other things to try to keep the prices down. But eventually, those prices are coming home to your and I's wallet. So let's look at that next, and we'll see where that sits.
So when we combine this conversation around inflation and what the Fed's trying to do, there also then naturally we have to talk about the kind of the big news item for this year, since February, has been the tariff discussion. It has a side effect here on inflation. We've heard, if you've been listening to the Fed again, we've heard the Fed talk extensively about not only just inflation not coming down, but the concern about, well, what could a lot of these tariffs that are being proposed, some of which have already been put in place, some of that are continuing to be delayed, but what could they contribute to inflation? Wells
Fargo is saying that tariffs could be adding 10 to 50% on some of the prices for what's happening here, and consumers may eventually bear about 67% of these costs. So if you've got a 20% tariff on something, you're likely to go up somewhere around that 12-13% mark in your cost. Companies like Hormel Foods, J.M. Smucker, Ace Hardware are citing tariffs as rising material costs. Retailers such as Walmart and Target have already began to implement price increases. And I noticed the other day that over at Walmart, looking at some items, they didn't even have price tags on some of the items. It was just had SKUs. And I'm seeing a little bit of that more and more. Procter & Gamble and Walmart have explicitly announced price increases related to tariff-related cost pressures. And there's smaller businesses like Princess Awesome that are relying on customer donations to absorb some of these added expenses. But how long can the consumer do that?
Right, and that is a key component with tariffs, though, is even though some of these price increases are pushed on to the consumer, as we were just actually talking about last week in doing some research, it does tend to be a one-time increase. So
it does.
Don't get me wrong, it's not great. It's not like they just go up and then come back down. We see this increase initially with tariffs, and then things tend to typically level off as those tariffs implement and get into the economy and we see them reflected in the businesses. So I guess the idea there is that there's this increase that's potential to happen, but it's not this year over year continual increase that the tariffs are going to cause.
It's the one time, and it stays there, and it works through the system economically. And really, you're going to see price increases, and some of that can be absorbed into the economy. There's no doubt about it. And in fact, we have an episode next where we're going to be talking about how to invest through all of this, but we do have some very practical guidelines we're going to get to more materially. But before we get there, I want to take a little bit about what experts really think here, that there are many experts out there that are saying consumer prices are likely to go up anywhere from 2 to 8% over the long run here over the next year. So we're going to look at it from a personal household point of view and how it affects each income level here shortly, but they use detailed reports on how tariffs on the Chinese, the Canadians, the Mexican portions of imports, as well as India, which just got that 50% tariff on all of their stuff. So they confirm that really every time something comes through the border, you're looking at increased rates right there. It's a one-time thing, but it's also going to stay there at those price levels. And very rarely have I seen prices ever really come down. Gasoline gets fluctuated based on stuff. I remember getting milk at, 25 cents for a gallon and, going to get milk, 50 cents a gallon, then $1.50. It was $1.50 for a long time. Now, what is it? I don't know, $3, $4, $5 a gallon, depending on if you want to get milk or not. But it estimates that prices are going to go up. There's no doubt.
Right. And it's, it's something where the idea behind having these not impact the economy in such a negative way would be that they happen moderately, they spread out, and sometimes with the size of some of these tariffs, that's a little bit harder of a dynamic to accomplish. So looking at the impact on the economy, there's price increases are inflation. The two go hand in hand, and we're likely to be seeing some of that over the course of the next year.
As long as it doesn't cause us to slide into a recessionary cycle, which would not be really good anyway. So let's talk a little bit more about where we're going to be here in each consumer direct cost economy. So there's substantial and varied evidence, direct cost pass-throughs to companies, and you have to look at how it's going to impact. So let's look at the household incomes and who's going to be impacted by this. So you look at the slide that's up there, and the tariff impact by category, we're looking at appliances and electronics by far are going to be the most expensive. Least expensive are going to be the food imports, which, that's pretty interesting, only at 3%. But everything else, shoes, 5%. Furniture, 6%, clothing, 7%. These are all major centers of consumer spending.
They are.
And it really is going to affect everybody in the economy.
And overall, we've got a 1.8% estimated impact on the CPI. So,
in other words, is that 1.8 added to the regular?
Yeah, right.
Oh, golly.
So that's in addition.
That's high.
So if we're at about 2.7 right now, we're talking, 4.5?
4.5%.
Yeah.
Ooh, baby. All right, let's see how it affects the average income for people. So the next slide shows you the tariff burden.
Yeah, so if we're looking at which groups these impact the most, we're looking at, naturally, it being the lowest income bracket having the largest impact on their income. We're looking at about 3% increase in their overall expenses based on, obviously, if you're in the lower income group, having less income, well, if you have what we're estimating about a $900 increase in expenses, that's going to be a larger percentage of your income. And so
that's somebody who's making $30,000 or less.
Right.
And people who are in the middle income category,
approximately
70,000. You're looking at a little over 2%, 2.1%. And then for those who make over 150,000, or it's a little bit under 150,000, 1.4%. So obviously, the more money you make, it's not going to have as a big impact on you. And my concern is actually, the middle to lower middle class are really the ones that get whacked in these kind of things.
They are. They're the ones already feeling the price increases the most from 2023, and another potential 3% increase to their expenditures is not going to be easy, and it could be a tough year or so for a lot of individuals in that income bracket.
So without being any kind of politics here, the reality is that there are good, healthy reasons to do or to implement a tariff where there is an unfair trade balance, and to use that as a weapon to get the attention of the other parties involved. Will it actually raise enough money to take care of our deficit or to do all this stuff? I don't think that's the case. I think the case here is that you have real targeted reasons to go after certain areas in the world economy that are hurting the United States. I am not brilliant enough to know which ones those are. However, this scattered approach leads us to give us a conclusion for steps for people to take. So here's some very practical steps that you can take personally to try to prevent this from hurting you even more.
Yeah, I think the biggest one and most obvious is just try to be cautious with any new expenses, trying to manage your budget more closely and monitoring your spending very closely. So that way, if we do see some of these increases, you've got the steps in place to be able to know exactly how much wiggle room you have in your budget and exactly what you can increase and what additional you can afford, especially if you're in that lower income group, the 30,000 or less, or if you're someone who's a big part of your budget is the food, as we've seen as being one of the bigger categories for those expenses. In addition, evaluate your investment placement because, with potential for these continued inflation, and we could be looking at interest rates staying higher for longer. The Fed has discussed maybe a cut this month in September, but it could be a very slow cutting pace that they embark on over this next year while they really try to evaluate and keep an eye on inflation. So making sure that you have some cash reserves and maybe having a little extra set aside rather than just investing every dollar you have can be a key component here to have that extra savings and try to seek those smart saving opportunities using those things like the high yield savings accounts, maybe even locking in a little bit of a CD for the time being to get a little extra interest on those stable, safe investments.
And the other thing is that you can look for smart savings opportunities. And a lot of people don't like to use coupons. A lot of people just want to go out and buy it when they want it, that kind of thing. But the truth is, if you spend time looking and you really need to get something, do some research, figure out what really is the reasonable price. I'm not talking just about cars. It could be about TVs. It could be clothing. It could be school books for your children. I mean, anything. Try to be smart. Look for those saving opportunities that it doesn't really cost you anything to look other than your time and your energy, rather than just quickly going out and doing something. Now, we are going to talk in our next episode coming up about really evaluating where you put your investments, because this is actually a really good time to be thinking about where you're going to put your money. In the meantime, the Fed, their mission, stabilize the economy, manage inflation, as well as growth in the gross domestic product through employment. Inflation is easing, but food and utilities, they remain high. And if in case you're wondering why dining out is getting so expensive, I want you to think about the fact that, first of all, there's no tips for certain people in some of those restaurants, but you also have to earn under $30,000 a year. And I don't know, those lower income tax bracket people are getting hurt anyway. Right. So I don't know there's many out there who are going to be able to take advantage of that, because you got to earn more than that just to, put yourself into a place to live and have food on the table. So it costs more to bring these people in. Then the food costs more. The insurance costs more. There's a lot of expenses that go into owning a restaurant that add to the cost that the tariffs are actually part of putting in place.
Right.
So again, tariffs are adding pressure, especially on the essentials that we have in our economy. Just be aware of that. And truthfully, this is not going to go away overnight. It's not going to go away over in a quarter. This is not so much a political issue as it is an economic issue. And so we're having to deal with it as consumers. So be smart, think ahead, and be wise with where you put your money.
I think that's well said.
Well, listen, we're glad you joined us today. Join us for the next episode where we talk a little bit more about where we're going to invest this money. And don't forget, live today for the tomorrow that's in your heart.
Because you'll never have more time to invest for tomorrow than you do today.
Thank you for listening.